watching Commodities First, and this is the OPEC special. I'm Mubina Kapasi, and right here we're going to be dissecting and debating everything that the OPEC and non-OPEC members have dissected and debated so far at the two-day meet at Vienna. And that's going to be the top headline at this hour. OPEC members end day one of the meet inconclusively with no decision on the quantum of the production cut. Russia's resistance to higher output cut is said to be the key reason for the impasse. Non-OPEC members gather at Vienna for day two of this meet. Saudi says there is a possibility of no deal being agreed to by the group at the end of the meet, but does say that scenarios of 1 million barrels per day of output cut are being discussed, and this caused Brent prices to crack and slip below $60 per barrel yet again. But meantime, oil markets ignore the big 7 million barrels US crude inventory drawdown seen after 10 straight weeks of a build-up. The US also records 3.2 million barrels of oil exports, the highest ever for a country that ended its self-imposed 4-decade oil exports embargo just 2 years ago. Moving away from crude, gold prices moved to a 5-month high amidst weakness in the US dollar as the Fed looks likely to hit the pause button on interest rate hikes. There you have it. Those are the top stories we are tracking for you at this hour in the world of commodities. But yes, talking about crude and everything that's transpired in Vienna so far, well, it looks like there is a no deal that has been discussed. And look at the way Brent prices moved on the back of that. We were steady at about 61.7 to 61.6 for the first few days. However, after initial comments from the Saudi energy minister with respect to nothing being decided yet by the OPEC members, there was a subsequent crack in crude prices, and we did slip below the $60 per barrel mark at about 59.6, 59.7 is where we are currently trading at. So yet again, sub the $60 per barrel mark, and it's something that has sent jitters down the spine of a lot of oil market participants. Not just that, take a look at some of the statements that have actually come in from from various quarters of the major oil producers, whether it's Russia, Iran, Iraq. Russia, of course, at this point of time seems to be circumspect on the quantum. They definitely do not want to take anything more than 150,000 barrels per day. But if Saudi and the rest of them are talking about a 1 million barrel per day scenario, then Russia would as well have to take in a bigger piece of that pie. Let me bring on board my colleague Vivek Iyer then to give us a roundup of what exactly has transpired at Vienna till now. Vivek, over to you.
Well, some incremental news flow coming in from agencies as far as the entire OPEC deal is concerned. Remember, the future of oil prices would depend quite significantly as far as what actually happens at this particular OPEC meet and what are the kind of updates we are picking up from there. So today what we understand is that Russia at this point of time may agree to a slightly larger oil cut than the $150,000 barrels per day. And what Iran is saying is that the Iran minister has said that OPEC ministers are all trying to reach an agreement at this point of time, and Nigeria is saying that an OPEC plus, so the OPEC countries plus the other countries too that are producing oil at this point of time and who are part of the meet are looking to cut close to $1 million plus barrels per dollar. In terms of it, what's actually happening, yesterday ended on a whimper, no specific deal was made. Non-OPEC allies too will join the talks today, and it is hoped that there will be some amount of incremental decision making be done, and the world will come to know what is the kind of output cuts that OPEC countries adhere to for the next 6 months at least. The Saudi oil ministry, someone who said that quite confident of ensuring that production discipline is maintained, and prices is something that they are looking at keeping at a stable for some amount of time. There's been a whole host of rhetoric around how oil prices should remain, right from Donald Trump, but this is something that will be decided post the entire OPEC meet deal.
All right, Vivek, thanks a lot for that. So far, if we have to sum up what exactly has happened in Vienna so far, well, not much, undoubtedly. Yeah, the point of whether or not to cut production has been more or less decided, and most parties as well have agreed to that. But now the question has moved to how much and how exactly is the group essentially going to divvy up all these cuts amongst themselves. On that note, let me introduce our experts then who are going to be joining us on the show to essentially dissect the importance of this meeting and the impact that it would have on crude markets. Reza Amanat, the Deputy Editor of Crude Markets for Middle East as well as Asia Pacific and with Argus Media, joins us now. Reza, It's great to have you with us on the show. This OPEC meeting does assume a lot of importance, and mind you, it's coming in at a time when the geopolitical scenario as well is a bit shaky, with Saudi being badly bruised on account of the revelations of the Jamal Khashoggi murder. It does sort of hand over the power to dictate the meeting to other players as well. But at the outset, I want to know your experience of whatever you have seen of OPEC meetings at times like this. Do you believe that it's come in as a surprise that these big guys have not been able to manage the oil markets by essentially imposing directions on the smaller guys on day one itself?
No, I'm not surprised at all. This was always going to be a complicated meeting, and it's not just about the smaller members, as you mentioned earlier on. Your colleague was saying that Russia is only committing itself to half of the cuts that it committed to last time around. So even bringing on an important producer like Russia is proving to be complicated. And many of these smaller OPEC producers, some of whom feel as though they need to be exempt from any of these cuts, Libya, for instance. And so those guys are not going to be able to contribute much anyway. And the biggest burden will inevitably fall on the bigger producers, such as Saudi Arabia, who clearly don't want to shoulder that burden by themselves, but it seems as though they'll probably have no choice.
So, Reza, do you believe that if Russia is not willing to hold up its end of the bargain of sorts, I mean, they are willing to cut output only by 150,000 barrels per day if reports are to be believed. So do you believe that even in such a scenario, Saudi would go ahead and still hold on, stick to its own output cuts, what it's supposed to, what it believes will help rebalance the market?
What we're hearing is that the Russians have said at least for the first 3 months they can't cut any more than 100 to 150,000 barrels a day. But after that, they may be willing to cut more. That might be due to some operational issues that they have. But to answer your question directly, I think the Saudis want some sort of a decision on an announcement of a cut, because anything short of that will be pretty bad for prices, pretty bad for their revenues. The only issue is that right now the expectations obviously in the market have been built up to, desire a cut that's more than 1 million barrels a day, but it's proving to be difficult to even get agreement around 1 million barrels a day. So if the announcement later on tonight or tomorrow is that the cut was agreed and it's only 1 million barrels a day, I think the market will still be disappointed, and this is the biggest challenge for Saudi Arabia at this juncture.
But Reza, wouldn't you find it a bit surprising given the fact that lower oil prices is a scenario that no oil producer is comfortable with, and still there's so much of reluctance on everybody's part, whether it's Russia, Iran, of course, it's a more political game over there. But wouldn't you find it surprising? It's a massive drop. Of course, we are not at levels of $35 or $40 per barrel like the last time when we had crude output cuts, but isn't it a bit surprising?
As I say, I think in the run-up to this meeting, I think others as well expected for this OPEC to be a very contentious meeting, not one that will come up with an easy decision. The biggest issue, obviously, is once you get into the nitty-gritty of a cut, once you've decided on a cut, is, as you said yourself, how you divvy up the cuts. And it seems as though that's where the biggest sticking point is. Where do you start the baseline from? Do you start a new baseline? Everybody wants to start from a baseline where their production at its highest. So realistically, how much effect any cut of that, which fails to take a big chunk of crude oil out of the market, will have, is something that they need to consider. But just to put things in context for you, at the end of 2016, when this first OPEC, non-OPEC production deal was agreed, the U.S. was exporting something like 600,000 barrels a day of crude. Last month, that export volume had reached 3.2. So the U.S. just by itself has added 2.5 million barrels of extra exports into the market. And so even if OPEC was to cut 1.5 million barrels a day, there's still, another million barrels potentially as being a million barrels more supply on the market than it was in 2016. So, of course, there is more, the whole market is more complicated. It also comes down to the quality of crude that's being supplied. I mean, the U.S. is mainly supplying light crude, and a lot of OPEC members have medium sour crude. So there is that mismatch in what is being cut by OPEC and what's being supplied by the U.S. But I mean, you do get the sense that the market is very different now to 2016, and to shore up prices, OPEC really needs to do something that's substantial.
That's a very interesting point you raised, Reza. Yes, of course, U.S. production has been soaring to record highs, but now with a 3.2 million barrel export figure recorded, U.S. has just showed what a dominant player it is in the oil markets now. Let me also, on that note, introduce Paul Higgins of Platts. Paul, hi, thanks for joining in. I'm going to take that point forward with you. Apart from the fact, considering the fact that, yes, the quality of oil differs, the fact is that U.S. as well now has become a dominant player in the oil markets. 3 million barrels per day of exports in the last month. So even, let's say, if the OPEC and non-OPEC members do agree to a 1 million barrel per day output cut, do you think that on account of U.S. production, we're still going to be in that scenario where supply is still exceeding demand?
It does complicate the matter for sure. You see the pressure now that OPEC are under. The fact is that they can't necessarily make the same cuts that are going to make the same difference to the market. I mean, you've got to think that Reza was making a good point earlier, and that the fact is that you've got to think that where prices are now, and the market is not that much oversupplied really, not compared to 2 years ago when you had a huge stock overhang. And it really gave them the sort of wherewithal, the sort of motivation to sort of address that overhang, to manage the market and bring stocks down. And they did that, and they were successful. What's happened now is that with the US Trump tweets and the Iran sanctions, they're thinking it was going to be with the Iran sanctions, they thought it was going to be a zero tolerance approach from the US. And then there was all these waivers. They got wrong-footed. They got blindsided OPEC, and Saudi Arabia and UAE produced at record production levels. So did Russia, and getting back off that high is the big problem now for OPEC. And this is the thing going into this meeting, is that while some members are looking for exemptions, it's where this base level is going to come from. Because if you cut from, if you're talking about cutting from where Saudi Arabia are making 11 million barrels a day, that's a big difference to when, say, a month before, when they were making 10.6 million barrels a day. So it's the devil is in the detail here.
All right. So, Paul, you don't believe that there is as much of a supply glut as there was 2 years ago when they first decided to actually impose these output cuts at this point of time. Paul, how would you say, or rather, how would you read into the dynamics between the members at this point of time? With Qatar sort of announcing its withdrawal from the cartel, and it's the first Middle East nation to do so, to announce its withdrawal from the cartel. Do you believe the bargaining chip of sorts has moved to smaller players now? Perhaps the disgruntlement amongst the smaller guys in the cartel against the dominant position of Saudi and Russia now is being reflected. And do you think that reduces Saudi's bargaining power?
And what you're seeing is something that's been in the market for some time, that for the past 2 years, it's not really been about OPEC, it's been about Russia and Saudi Arabia. And while most members have been accepting to put up with that, I mean, even back in when Russia wasn't part of that equation, really OPEC was really about Saudi Arabia. Yes, Iran and Iraq to some degree, but it was really about Saudi Arabia. And now again, this is about Russia coming in and Saudi Arabia and Russia having this new alliance. And I mean, the same problems have always has been persistent before. That what's happened now is that you've got members that are struggling to maintain their market share. Venezuela, Libya, Nigeria, and Iran under sanctions. These are all members which are all having significant issues with their production levels, with sanctions, and they've got a right to sort of mistake their claim for their own countries to try and get the best deal. And this has always been the case at OPEC and these agreements, in trying to get the best deal for each member competing. But ultimately, when it comes down to it, these members it's going to be, if they don't get a deal, it's going to be detrimental to all concerned in the producer group. So while there's a lot of negotiating, a lot of hard talk, you'd be surprised if there wasn't some final agreement at the end of the day.
Okay, Paul, so you are expecting an agreement. So I'm going to ask you to look into the crystal ball, and based on whatever you have seen so far, based on all the communication that has been seen on media reports and interviews, what do you think? Is Russia going to bend to Saudi's request now? Not a demand, but a request rather. What is going to be the likely outcome? A cut, I think, is something that mostly everyone's penciling in. But the question is now how much?
Well, if you remember, with Russia is a big factor. And if you remember 2 years ago, Russia did not cut straight away. It's a Russian winter now, and it's very difficult for them to just turn off the taps and turn on the taps willy-nilly, not like Saudi Arabia. And at that time, they were given a 3-4 month, well, not given, they agreed to that they would get up to that 300,000 barrel a day cut back 2 years ago. In the spring, once we'd seen the end of the Russian winter. And this is the size of the cut is going to be a sticking point again. Russia aren't going to be prepared. It's going to be very difficult to prepare that sort of size cut for Russia. And we've already seen that from media reports as well, that they're not prepared to stump up a big enough cut. So it's a case of, the key thing will be how they communicate the agreement. There will be some flexibility for some of the big players. There will be some nuance in the agreement, and to allow the breathing space for some of these members. And that is where we're at with the negotiations right now. But I think the market's expecting 1 million barrels a day minimum. And if they don't deliver that, we'll see probably, one, a disappointment, and two, an existential crisis for OPEC and Russia. Where does it go next? Does it get back on the table in a few months' time? Or does it, like Reza was saying earlier, does it extend the meeting even further until tomorrow if an agreement isn't made? It's going to go right down to the wire.
Okay, excellent. So 1 million barrels per day is more or less what the consensus seems to be. On that note, gentlemen, Reza as well as Paul, thanks so much for joining in on ET Now's Commodities First to essentially understand all the plethora of dialogues that have come in from various ministers at Vienna. OPEC and non-OPEC members, remember, have gathered in over there. But like I said, the consensus seems to be an output cut of at least 1 million barrels per day. And that would perhaps provide some support to prices. Here are Peter Maguire of XM Australia and Sambit Mohanty of S&P Global Platts on what their expectations are.
Well, I think a couple of things. If we see a 1 to 1.5 million barrel cut or more, then that's really going to underpin and give a lot of credibility, and I think should support price from its current angle. You may see an increase on that number. It's a little bit undecided, but I feel as though that's been the general consensus over the last 24 to 36 hours here on the street in Vienna. And if that is to continue with that sort of forecast and that's what materialises, then that could support pricing in the short to medium term. There'll be further softening, I think, across that energy sector. And I feel as though that you may see a weakening of Brent and WTI over the, well, it'll probably bounce after the announcement tomorrow, but I think you'll see structural weakness in the energy markets over the coming week or two.
We at Platts are expecting that OPEC and non-OPEC, they will continue to have those discussions and aim for a cut of around 1.2 to 1.4 million barrels per day, because that's what we think is needed. Anything less than 1 million barrels a day could trigger a sell-off. So the market, they know that for any meaningful impact to happen on prices, the cut has to be at least 1 million barrels a day. In fact, yesterday the six-country monitoring committee also recommended that 1 million barrels a day cut. So we are still expecting that to happen. And at Platts, we believe that if that happens, then we could see oil hovering around 60 to 70 in the earlier part of 2019.
Okay, so as we await what the outcome will be of the OPEC and non-OPEC members meet, crude for now has just managed to stay at that level of 59.70, 59.80. Let's see what the outcome is, or even for that matter, if they'll consider extending the meeting to tomorrow, as Paul just mentioned. Okay, let's bring on board Renisha Chainani then. She's the head of Commodity and Currency Research with Monarch Net Worth Capital. Renisha, hi. Thanks for joining in on ET Now. Let's start off first with your view on natural gas. You know, this was one commodity that just a couple of weeks ago saw significant volatility, global prices. What's your strategy when it comes to natural gas MCX?
Yeah, good evening. I think natural gas prices were exaggerated because of the news of supply constraints, but gradually we saw prices subsidizing. And today we have seen that prices have broken their important support of 300 at MCX. So I'm expecting a sell-off that could come down to 290 to 285 levels. So I would recommend a sell strategy on natural gas for a day or two for the targets of 285.
Okay, let's talk about other commodities then, and I want to speak about gold because we did see massive buying coming in over here as well in international markets. What about the on the MCX? What's the strategy you'd suggest here?
I think from last 2 days, as market is in the risk of sentiment and gold is getting some support from there. Internationally, we have seen that COMEX gold prices have broken its resistance level of 1245 and are heading towards 1250, 1260. The next resistance that prices can touch is $1,280. So I'm expecting this up move to continue as ETF buying has been very good. Central bank buying has been good. There's good festive demand in India and China during this month. So good gains that could coming in gold. Buying could be initiated around 31,100. That are the current levels with the stop loss of 31,000. And we can see the targets of 31,250 on the higher side at MCX.
Okay, and finally in base metals where things as well have been tough once again, LME, copper for that matter, did see a bit of a rebound come back, in fact 1% higher. But yeah, you have a buy on copper MCX?
Yes, copper has very good fundamentals. You've seen that inventories have fallen almost 60% from the April month, and gradually prices are recovering from their lower levels. Good demand coming in for steel and other metal products. So I'm expecting a rebound in copper towards 439 to 440. So buying is recommended on dips, and targets could be seen like 440 on the higher side.
Okay, great, Renisha. Thanks so much for joining in and giving us your top strategies for all commodity traders. But this is, of course, Commodities First, where we also give you a sense of what should you be watching out for come next week and the important macro events that are going to move commodity markets. Let me bring on board Pranay Jain, my colleague, to tell us about these events. Pranay?
Well, there are several cues next week, and amongst the important ones, China will be releasing its trade data. So the export growth is seen at about 9%, import growth of about 14%. So there's a trade deficit of $34 billion which is anticipated, and that is similar to the previous month. Also, the industrial production numbers for November in China will be coming out. The forecast as of now is about 5.9% growth. This again is similar to the number that was clocked in the previous month. Japan will be publishing its Q3 GDP, and the print is expected to show a contraction of about 0.5% versus 0.3% dip that was seen in the earlier quarter. This is as per the Economist estimates. From US, you will have the initial jobless claims coming out, and for the week ended December, the number is expected to be in the range of 200 to 250,000 compared to the earlier 231,000 that we had seen in the previous week. So the job market continues to remain strong and steady over there. The industrial production number for November should show a marginal uptick of 0.3%, and also the manufacturing PMI is expected to show continued expansion. The number is believed to be around 54-55 index. When it comes to UK, there will be the important Commons vote on Brexit deal, and you must know that the senior Tories have been urging UK Prime Minister Theresa May to postpone this Brexit vote in order to buy more time to plead for a better agreement with the EU Eurosceptics basically in Brussels. So whether we see a delay or whether the emergency talks with cabinet ministers in order to avoid a heavy defeat works out, that will be important to watch. From Eurozone, you'll have the industrial production number for October, which is expected to show a growth of 0.5%. Also, there is the important ECB meet, but it's most likely going to be a non-event because no rate action is seen this time. Lastly, the EU manufacturing PMI is expected to be steady at about 53.5, similar to last month.
Okay, Pranay, thanks a lot for that. Well, on that note, we'll wrap it up on this edition of Commodities First, waiting for the OPEC and non-OPEC members to decide on the output cuts. Thanks for watching and stay tuned to ET Now.